Wow. Do you want to go on the bench and I go there?
Yeah, let's take the bench.
Hello, everyone. My name's Neil Murray. I'm a tech journalist with tech.eu and the Nordicweb. I'm joined today by Mattias from Atomico and Nelsin from Nasdaq. We're going to talk about IPO trends. In particular, we're going to talk about late-stage funding and a term which has arisen, which is Quasi IPOs. So if you want to maybe just briefly introduce yourselves, and then we'll just kick off with if you want to have a crack at what a Quasi IPO is.
Great. Okay, so my name's Mattias Ljungman. I'm a partner at Atomico. Been involved in some late-stage businesses like Supercell, Klarna, actually Truecaller. We can throw that one as well. So that's me.
Great. My name is Nelsin Griggs, and I run Nasdaq's global listing franchise. So the 3,500 companies on Nasdaq are under my watch, as well as the companies that are going to consider going public. So spend the time traveling the globe, talking to pre-IPO companies.
Do you want to have a crack at what a Quasi IPO is?
Sure. It's a new term that has been kind of coined to describe late-stage funding rounds that have taken really the place of IPOs that would happen 10 years ago. So the capital raise ranges from maybe $40 million all the way up to several hundred million. So it acts like an IPO. A lot of times the funding comes from mutual funds or private equity firms that are, again, acting like they would in the public space. And all it really does is help the company extend their life cycle as a private company and do things they want to do that aren't subject to the quarterly ups and downs of the private market, public market.
Yeah, okay. So I think one of the main reasons why we've seen these Quasi IPOs is because later stage funding in Europe is perhaps more readily available than it once was. I mean, it's still a long way behind the US, but because it is more available, rather than going public to get capital, companies are able to get capital at that later stage. So, Mattias, you just did some research pretty much on late stage funding.
Thank you for letting me give the plug. So we did some research together with Slush, which you guys can have a look at. You can find it on our website, but we did a sort of magazine version together with Slush. And if you look at the report, it's pretty interesting because if you compare the Europe to the United States, so on average, Europe has 5 times less funding than the US. But if you go to late stage, it jumps significantly to 14 times. So we're very, very different kind of beast compared to the US. So I think that's something that I'm pretty passionate about, because if we're looking at the change that we've seen over the last few years, we're creating better and more interesting companies. There's a lot of innovation that we've seen with smartphones, with the App Store has been built from 0 in 2007 to a 30 billion industry. And so we're getting bigger and bigger companies. And these companies, to be able to go to the next stage, are going to need capital. Because still, before companies reach $1 billion valuation, our analysis is that they need to raise around $250 million dollars.
Yep.
And I think, as Nelsin pointed out, is that we're in a sort of a new phase of in the world where companies are remaining private much longer. And I think there's a requirement to sort of define that segmentation a little bit. So.
Cool.
And I was going to add, this is relatively new in the US as well, too. That since in 2012, it represented about 15% of new money going into private companies. Just this year, it's about 30%. So this is an evolving trend, and it will certainly find its way to Europe sooner rather than later.
So what about, this trend happening, how does it actually affect the public market? How does it affect you guys? Do you see this as a positive thing, that companies are raising money instead of going public? Is it good for you or bad?
I mean, obviously, we'd love to see more IPOs, but that said, we'd much rather see good IPOs. And if companies have the ability to really codify their business model in the private space and can pivot and do things they may want to do, go into new verticals and do that privately, and they get to the market much healthier, they ultimately feel like we'll get them. So that's a good thing for us. We're happy.
I mean, I think it's very positive. I think being sort of, like they say, quasi-public is a benefit. Companies get to build on their different components of their business. Creating that stability that's required before they go IPO. I think before you jump in and actually create the stability afterwards. Now you're getting a little bit more time. Maybe you can be a little bit more aggressive. but you still need to work with corporate governance and all these other things, which again, it's not that easy. You need a great management team, you need a great board, you need a great product, and you need to understand how you're going to go international. But to me, the worrying thing, like I said here in Europe, is that on the later stage, there's not enough sort of European capital going into later stage companies.
No.
And so what's happening is that companies have customers all over the world because this is what the new world allows us to do. They then have investors from all over the world.
Yeah.
And what Nasdaq is also being able to do is attract companies from everywhere to sort of list in different geographies. And so these companies that are sort of born out of Europe don't necessarily end up being European. And I think having local big investors supporting these companies is important, in the next evolution of the companies. Today, it's not a problem, but I think the next evolution, it's going to be important for them to have the sort of base coming in, which, I don't know, Nelson, you've seen this a lot in the US, the big actors coming in.
Right, so the way that companies are doing this, really probably a year or two before they go public, they're spending time doing non-deal roadshows, talking to investors, so when they ultimately do go public, they're not shaking hands for the first time with the people they're trying to get to invest in the company. So they are starting to go proactively, meet with the mutual funds, meet with the pension funds to tell their story. And at the very least, that lets them have an easier on-ramp when they do go public. Or it may mean they get funding prior to going public.
But the fact remains, companies are still going public. It's just later, right?
Yeah.
It's just later. They're more mature. The ones that are doing this are going to be more mature, but they are doing the things that were mentioned. They are getting their corporate governance lined up. They're figuring out investor relations. They're actually doing quarterly earnings calls prior to when they go with their smaller group of investors. So when they do ultimately go, they feel like they've been almost public for a period of time.
You asked that question in Europe. I remember 5 years ago, people were wondering if we could get companies reaching $1 billion valuation. It was a big question. It was only 5 years ago, and we were wondering, is it possible for them to really create scale? And now, over the last 5 years, we've had over 100 IPOs in the tech sector. And actually, if you look at the amount capital raised in IPOs, Europe is outperforming the US, which we would never have believed. And of the 37 billion-dollar companies that have been created since 2003, over half of them have done an exit. So again, Europe is performing very well.
We did some research on TechEU, and I think last year, in terms of tech exits, it was about 5% in IPOs. And my kind of gut instinct is that it's probably lower than it has been for exactly the reasons that we've talked about. But I mean, does it kind of matter what percentage of the exits are IPOs? Like, is 5% a good number, a bad number? Does it matter?
I think that's really the issue here. The real thing to talk about, does it really matter? And I don't think it really does. I think if we're looking at these later stage deals, what's happening is companies are behaving pretty much like a public company. So in that transaction, you're going to have maybe management selling a little bit, or some parts of management releasing a little bit. You're going to also have maybe early investors who've been at seed or think, okay, this is the right time for them to get out. And then, of course, you're raising capital, and then you're boosting your board or whatever else. So,
Yeah, the only thing I'd add is just the technology companies across the globe now have more cash on their balance sheet than they've ever had. And you get to some scale, whether it be a Google or what have you, they look for acquisitions in the private space every single day of the year. So they have teams that are doing that. So I think that lends itself to M&A a little bit more too, and different types of exits and IPOs, because their need to grow is going to be dependent on finding startups that can help them fuel that growth.
But from your perspective, you would like the number to be higher than 5%, I'd imagine.
I'd go, a lot more.
Yeah.
A lot more, sure.
Cool. So it's been in the news kind of recently. We've had a few IPOs kind of put on ice, postponed. Bad timing, bad market. What's the deal? What's your take on this?
I mean, I think that there's two companies that, I think that people have been talking about quite a lot that they have postponed. And I think, one of them is very much, in my view, this is my personal view, I think it's very sector related. I think the other one may be trying to get out in the market a little bit too early. Great company, growing fast, but if they waited a little bit longer, maybe they'd had another type of reaction. But again, I go back to the stats that we have that show that it's been, again, a great year. I mean, last year, in 2014, the top 5 IPOs that happened globally, 3 of them were European, right? So, and we saw WorldPay list in London. It was the biggest IPO in the UK for the last 2 years. Probably one of the biggest sort of secondaries. So there's about $1 billion that they took off the table. So it's, I think, it's for the right companies, it's very healthy.
Would you agree?
Yeah, and I was in London these last few days, and I did see the news, and it seemed like it was a little bit overreactionary in my mind, because this happens in the U.S., and I wouldn't say a lot, but about the deals that go on the road, there's going to be 5 or 10% that don't get out.
Yeah.
So we'll have about 140 U.S. IPOs on Nasdaq, and it's not uncommon with a choppy market. If the valuations in there, it could be a very healthy company, and they don't want to go out at a lower valuation, or it could be one that just the investors weren't ready for it yet. So it wasn't, to me, a reflection of anything other than just a choppy market.
I mean, to me, I think like anything, we want things to get better. We want the system to get even stronger, to be more sustainable, and have all the right components to it. And I think that is really, as it looks like, if we look at the companies that are coming through, or the sort of seed, Series A, Series B, they're getting well funded. To me, it feels it's time. It's kind of on our side, and it's not a straight line. Nothing is a straight line.
And I'll just add, we're going to have a record year in the Nordics. End of this week, there should be 79 Nordic listings, a lot in the First North, which is a nice growth market. So there's a pretty good global IPO market in general.
And I think there's a correlation there in terms of the funding coming in as well, right? Because record year in terms of funding here, record years in terms of exits. So that kind of correlation does tend to fit quite well.
And you had a great 2013 and 14. So you're going to have these, the market doesn't constantly do this.
And I think actually in the Atomico report as well, it does touch on that in the sense that there is this kind of big funding gap, but there's also, we're kind of going to see more billion-dollar company, like the valuations are going to come through in the next couple of years.
Yeah.
Because like the majority were the last couple of years, right?
Yeah.
So it's like 90% of before.
Yeah, so the average time for a company to reach $1 billion valuation is about 6 years. And really, the dramatic change in our ecosystem has happened over the last 5 years. And I think that those companies are obviously not coming through yet, the ones that have got going 3 years ago. And so we're going to see a bigger cohort, a stronger cohort. And I think it's, again, the thing that we talk about, it's success breeds success. And the more billion-dollar companies that are created, they're creating another level of great management that are then going off and creating great companies, or those founders of those billion-dollar companies are supporting younger companies and helping them raise more capital, find great people, and then those become successful. So this virtuous circle, which is one of the hallmarks of a great ecosystem, is happening here. So I am very positive that if you look forward, we will continue to have good companies coming through. And then, of course, there's going to be bumps, but I think overall it's getting bigger.
Do you have anything to say?
Only thing I'll add, and I don't want to throw any cold water on the billion-dollar valuations, but you do look at the headline numbers, and there's quite a lot made out of a $5 billion valuation, or 15, or 1. And under the covers, you have to look a little bit about the terms that the investors get, the different classes of shares. Because there, a lot of times, especially these late-stage quasi-round IPOs we're talking about, those investors, they have a lot of protection on the downside. So the true valuation may be a little bit lower. Companies love it for a marketing tool because the headline's there. It helps them attract employees. It helps a lot of things to stimulate some growth in the company. But I wouldn't get too carried away sometimes with just the headline billion numbers, and because it's maybe not quite at those levels.
And that's almost the crux of the bubble talk, right? Like the fact that these companies with these huge valuations, what would happen if they went public, and it's kind of almost at the crux of the whole bubble talk.
But to me, we talked briefly before, and one of the things that I think is interesting is that in the US you have a lot of support from a broader investor base, so the mutual funds and so on. There's some that have been in this sector for a very long time, and then there's new ones coming in that you get, right? And so in Europe, we don't really have that. We don't really have these big institutions, and And I think, like you say, some of these institutions, they behave a bit like they're investing in public companies, and so the safeties that they want are going to be very, very different from what other type of investors are going to be. And so, what I'm looking forward to is that we saw, and this is just me, I haven't done a lot of research on it, but private equity, the European institutions, which, by the way, in Europe we have a great concentration of lots of very big institutional capital, but they haven't been involved in our sector at all. Very few exceptions. And what we saw in private equity was it took a long time for European institutions to get involved, but once they did, they got really big and actually became the biggest component. And I'm thinking this might be something that we could look towards, that once they get comfortable with this asset class, actually you'll see more capital coming from these larger institutions. Because it makes sense for them. They are searching for growth. And we look at the growth rates in our sector compared to GDP, which is a couple of percent. We're getting multiple percentage growths, and e-commerce is still growing at 25%. SaaS is growing more than 25%. It's a phenomenal growth, and they need to tap into it.
Do you think we could see that happen?
I would be surprised if it didn't happen. I think just as mentioned, they're all searching for growth, especially with the PE firms today, with interest rates maybe starting to creep up and money getting a little more expensive for them to do the traditional leveraged buyouts. It certainly makes sense. They look at this asset class, and again, the protection, they don't act like a VC. A VC is going to have 1 out of 20 hit. The PE world, the mutual fund world, looks at the downside protection and less upside, but they're willing to take a little bit more of a bet than they would go into the public markets. So sure.
Okay. We've got about a minute left. I guess as a kind of close-in point quickly, do you think that they can kind of grow in correlation? Do you think we can see more Quasi IPOs next year, the next couple of years, these big late rounds, but at the same time experience the big exits as well? They can kind of correlate, or do you think at some point it will begin to kind of even drop the 5% even more?
Well, Nasdaq started a whole private market initiative based around it, so we're believers. Our viewpoint is that companies have to control their destiny, and in order to do that, they have to have an efficient way to manage their capital and make sure their employees get rewarded along the way. And it's part of the whole ecosystem we think is not going to go away anytime soon. So we're very big believers in it.
Okay. Maybe it's a cop-out answer, but it's a buyer, and there's always a buyer, there's always a seller, right? And that's how you create this transaction. And I think usually the market is pretty good. Sometimes it overcompensates on both directions. So we'll see. And maybe we've been in a period that there's certain companies that have been over bullish, and we might see the other way around where it goes a little bit too negative. But to me, I think where we are in the space that we're in, it feels like we're in the right spot.
Cool. A prediction for the market was a pretty harsh last question. So sorry, guys. But yeah, please give it up for Mattias and Nelsin.
Thank you.